What's up, YouTube? Stocks by the numbers. Welcome back. Wanted to do a quick update here on Under Armour Incorporated, ticker symbol UAA, listed here on the New York Stock Exchange. 940. The stock just closed up 34 cents, exactly 3.75%. And this is basically the difference between a trade and an investment. This is what I wanted to talk about. Just to catch everyone up here, this right here, back here, end of June, I believe, was the first time we looked at the stock. I noticed this double bottom here on the technicals, little descending wedge. But I basically mentioned overall, in my opinion, that the investment, not necessarily the trade, could potentially be a good idea, in my opinion, for the longer term. We noticed this gap down here, and I was looking for this 1370 level, and I even laid out for you that, hey, listen, it could, of course, can just explode, because markets were running here June, July, if you recall, when we looked at it. That was the summer rally. So that's why I said, hey, listen, if they really beat earnings, who knows, the volume could start coming in, and people, we could pump it up and get here in the next couple of months. Or, it can pause and they can drop it down if they miss maybe or something, and it'll slowly, begin to step higher. And what happened? Well, the stock broke out on the technicals, got up to north of 8, began to consolidate. We come into this earnings report here, we can see a nice beat on the top and bottom line, but then of course the stock continued to drop down and hit new lows of 629. Earnings were reported early August. If you recall, August, September, October, markets were selling off and dropping down. But what happened here, end of September going into October? What happened was, this was one that actually went higher while everything was going lower in October, because we can see that they brought it down, in my opinion, just way too low, down to 629. They forced it to hit new lows, and then it just immediately reacted and spiked back up to not only 7.5, but retested the fib, and obviously continued to climb over the last several weeks as well. Because as we come in here, yeah, so obviously it had the big drop here, but as you see, this was throughout October. This was the second, third week of October when everything was selling off. We had Under Armour rebound and explode back up to north of 7.5. So this is why I say sometimes it is better, depending on the company and the specific situation, it is better to sometimes look at the fundamentals as opposed to the technicals. Because if you started buying here at 7 or like 7.5, let's say, you waited for it to pop out, and you saw it go up $1, and now all of a sudden you're down over $1 and it's at new lows. Well, that's why I say, if you look at healthy brand name companies that we're buying at a discount, we know they fluctuate. And if we liked it at 750, we're going to love it down here at 630. And again, even if you added shares here, let's just say as it broke down here, you bought more shares at like 670, and then you saw it go lower, and it even broke down here to this support line of around 6. It's like either one of two things. Either A, don't get emotional because you knew it can happen and you're holding on for the long run, so there's no reason to even watch it and stress myself out. Or B, oh, I have even more cash, so I'll buy even more here at a lower price. Those really, in my opinion, should be your two options, especially if you have the capital to buy shares as opposed to options, of course. But this is why, this is what I wanted to show you. This is the difference between the trade and the investment, right? We had the double bottom, the wedge forming. We had the technicals in our favor. So we step in there if we wanted to at like 7. You can buy some calls. The stock popped out as projected and predicted, really. And, we got up to 840 or whatever it was. And you have to be in and you have to be out, right? That's what we always say. It's a trader's market. You have to be in and out. No one ever went broke securing profits. Yeah, it popped out. Okay, you sold it at 798 and it went to 844. Like, who cares? You know what I'm saying? You did the due diligence, the research, the analysis. You got it right. You saw the pattern. You kind of know what you're talking about. You made the right call. It popped out. Now the option's up big. You just made X hundreds, X thousands. So you understand what I'm saying? That's it. It's a win. You're in, you're out. That's it. People need to, in my opinion, stop trying to impress everybody. Because, first of all, unfortunately, no one really cares. But also, more importantly, on the flip side, you're actually potentially hurting yourself and messing with your discipline that you should be having when it comes to trading. And that's why a lot of people, a lot of successful, well, not, well, obviously we define success differently, depending what we're looking at, but consistency, all right? We'll go with consistency. The most consistent traders are the most disciplined traders. That is essentially a fact. I don't even think that's an opinion. That is a fact. And the reason why the disciplined see better results is because it's a process and you have to trust the process. And there are people who, they might have just a list of who knows, like 10 stocks, and maybe that's a rule that they have. I'll only trade these 10 stocks. Who knows? Who knows? I'll I'll never take a call put position for this Friday. I always allow myself a minimum of 2 to 3 weeks. That's a rule. It might sound silly, but they may have learned the hard way that by not doing that, they're only correct 55% of the time. By buying and paying a little extra for more time up front, maybe their success rate is now 79%. That's a big difference. There are people who might say, I'm only running, 1 trade a day, 3 trades a day. That's it. I don't care how much I make, how much I lose. That's it. No more than 3 trades a day. I'm only putting X amount of dollars in each position. I'm never risking more no matter how much money I make. If I take positions and I see at least X% return in the option, I'm out. I'm in, I'm out. I'm securing profits. There are people who have dollar goals every day. I know young people, they're working part-time jobs. They're in university or college, right? They're taking classes and they'll try to look at their phone, run some trades, talk to some people about some trades, some investments in their downtime. You might have like a $50 goal every day. And it doesn't matter what it's on. I bought a call on DIA this morning, the option, I usually look for at least $50. It ended up running, the option's up 110%. I'm up, $92. That's it. I'm in, I'm out. I'm happy. I'm in, I'm out. And that goes back to the original point. Stop trying to impress everyone. Stop trying to be some sort of financial genius or some stock savant or trading guru. Forget about all that. Forget about timing the absolute bottom and selling at the absolute top. And that's what I mean. A trade like this. Oh, I sold it at 8 and then it went to 840. I could have made an extra, $260. It's like, bro, who cares? Who cares? You did what you had to do. You saw the analysis. You got it right. You made money. You're in, you're out. Like, what is negative about that situation? Like, move on. On the flip side, I know I just went off on a tangent like I always do. On the flip side now, we come back to the investment, though. That's what I'm saying. This is why when you trade, you have to, it's much more stressful. You have to be much, much more disciplined. In, out, secure profits. Don't leave it up to the market. No guesswork. We're in, we're out. And of course, when it comes to the investment, this is why I say investing for the longer term is obviously, in my opinion, much, much easier and much less stressful. And that's why when we look at these brand name companies, no matter what they are, whether it's Under Armour, Coca-Cola, Hershey, right? If we're buying brand name companies and we're buying shares, of course, then if we like it at a discounted price and we feel it's undervalued, maybe in the numbers, we can begin to piece into the position and take a position. So what do I mean by that? Well, let's say you had like 10 grand. Start here. Start here at around $7. And if you want, it depends how much more money you have coming in. And that's what I mean. Like how everyone's financial situation is different. But you want to piece in 2, 3, 5,000. You want to step in. You give it some time. Okay, it started to run up, but now it's rejecting. It's pulling back down. Oh, maybe I'll be able to add more shares over here at 7. You add more shares here. It bounces, then it rejects, and holy crap, they're really beating this up. It's in the low 6s, making new lows. Okay, I'll throw a couple of thousand more in here. I'll average down. And you understand what I'm saying? So you got to play with it and take what the market gives you. And unless either A, some random horrendous negative catalyst comes out about the company or someone on the board, you're probably not going to get screwed over too much. And B, also, this is why it's easier to look at brand name, fundamentally proven and sound stocks. Because we looked at a lot of, other wishy-washy fundamental companies here on this channel. Fuel Cell, Enovix, Microvision. You got your other companies like D-Wave Quantum, right? That one ended up selling off down to whatever, like 70 cents or whatever it was, 68 cents. And that's what I mean. It's like with those companies, you can just randomly drop. And with these companies, well, hold on, wait. To go back, they can randomly drop, but also at the same time, because they're not fundamentally sound, you don't know what's coming next. Right? So I called, in my opinion, looking at the chart, I saw the fib level of 68 cents on D-Wave Quantum. So I said, in my opinion, it should come back down there, and then maybe you can, have a bounce back up and start running 80, 90, a dollar. But also, if the companies are not fundamentally sound, anything can happen. And it could break that 68, it could have broke that 68 fib level and then drop down to like 55 cents or something like that. You know what I'm saying? So they're more unpredictable and they're more volatile. And that's why knowing when to, I guess, double down, as people say, or average down on stocks like that, much, much harder to have conviction and confidence doing it. As opposed to, again, something like this, the Under Armour, yeah, you buy more shares at 650 and it drops to 629, all right, whatever, it's not a big deal. Or you buy shares here at, 640 and it continues dropping and it ended up dropping all the way to $6. Like, it's interesting because it seems like the same thing, but it's really not. And it's hard for me to describe because, like, something like a UAA, I would say, in my opinion, would have a much, much higher chance to bounce off a level like this than one of these newer, smaller infancy stocks that we've looked at where we draw a support line and, we're trying to predict that it'll hit, but then definitely bounce from that. Like, you know what I mean? On the smaller, riskier stock, there's like 10-20% chance, in my opinion, that it could, like, definitely bounce up off that level. Something like UAA, I give it like 70-80% chance. And then that's what I mean. That's why I even talk about the flash crashes. Like, even if they brought it down here to like 608 and then it like chunked down to like 590, like it would have immediately like regained. You know what I'm saying? We see that with all of these companies, even Hershey. Right there. Right? That was like the I don't know, all time or long term. I don't remember right now. But this was Hershey. I did a video on it a couple of days ago, and this is what I said. I said, chances are, in my opinion, it'll come down, bounce off that support line, and we started seeing some life here. But as you see, it had like that flash crash, right? So if we come here, we can see 181.66. But what was the low on that candle? 181.30. You understand what I'm saying? So we could flash crash, but the chance of holding this line and then bouncing off of that line are 70, 80, 90% high. When we look at a brand name company that we're looking at on a discount, it just is that way for the most part. And again, something... they're all different, and I hate to just keep going at the same name companies, but, something like a Laser or like an Enovix, where like it's in the crosshairs, like traders like it, but technically you all kind of brought it up too high, so like at any moment it could sell off. Like, so there is no like definitive way to say, oh, it'll pull back $1 and then it's going to bounce off and go higher. Like, no, it's not guaranteed. And, a bunch of people could all of a sudden find it and see what I see and start shorting the crap out of it. And then it just completely breaks through that support line. But if you notice, the companies that don't bounce and just break and continue to get worse and worse, where people are like, what's going on? Where's the bottom? What's happening? Think about it. The companies we looked at where that happened, they were all like these BS overinflated startup companies that said they needed like 4 years to even get revenue in, and all they're doing is losing money. They're not doing any business, and they're consistently bleeding, and you already did maybe 1 or 2 reverse stock splits. Like, you understand what I'm saying? Those companies don't deserve to bounce off of the support line, nor do they have the proven stability and fundamentals to support an actual bounce off that support line. So that's why something like a Mullen will, it could just randomly break through a trend line, and that's it. It's over. Now it's hitting new lows. It's starting to tank. And I know I'm kind of all over the place here, but I don't know. In my mind, this is how you have to be. I know everyone's different, but basically, the vibe here again, we had the trade, and it looks like we have the overall investment, and we can say, oh, look at that. Boom, look at that. No, anybody could draw out that stepping path there, but that's what I mean. I did say, because I might have a little bit more experience than you. I may have watched a lot of these companies, how they react after earnings, or what might happen if the market starts selling off, or that's what I mean. Now something like that, like Under Armour's flying underneath the radar, and literally, what is this? November 1st. In the last 6 weeks, the stock went from 6.5 to 9.5. Right? So think about that. Stock's up almost 50% just in the last couple of weeks. And this is why I'm saying, in my opinion, I do like, especially if we're talking about preserving and growing our accounts. Right? I'm not talking about, boom, holy crap, I made 10 times on my money with this spec trade. Like, that's not what I'm talking about. I'm talking about the longer term account. It just seems to me that, having a list of brand name companies and just waiting for them to get beaten up to these discounted levels, and then just starting to build a position and scoop up shares before it just like slowly rebounds underneath and I can almost guarantee, going into this earnings report, in my opinion, the stock will probably be close to double digits. And yeah, it'll be, sitting around something like 11 going into these earnings. And then all of a sudden, they're going to be talking about it on like CNBC and Fox Business and all of these channels. Oh, have you seen Under Armour? Oh, the stock is on a tear. It's up 100% in the last 3 months. It's like, yeah. Now you want to talk about it. When we looked at it and we felt it was significantly undervalued in the fundamentals, and it just made no sense at its current valuation, no one talked about it, no one cared about it. While we were building our position, basically knowing high conviction, 95% convinced, high conviction that this stock is going to rebound and go higher, no one was talking about it when we were building our position. Now that they brought the stock down to new lows of 6.25, and also over the last 90 days, hypothetically, this is a hypothetical situation, of course. Hypothetically, it ran from 6.5 to 11, and now we're going into earnings. Now you want to talk about it, and that's also another reason why I like to swim against the stream as well, because the average trader, look at the stocks that they look at. You go in the average trading Discord, what are the stocks they look at? You basically don't even need to pay these people half the time, in my opinion, because all they do is watch the same list of tech stocks and just look for, wedges and double tops and whatnot, and, that's it. So, listen, obviously, more power to you. However you make the money, right, at the end of the day. I'm not necessarily knocking anyone's strategy. But the point I was trying to make was, this is why it benefits you to just kind of think outside the box a little bit, right? The average trader or finance YouTuber is probably talking about, NVIDIA, AMD, DraftKings, Tesla. Here on this channel, I'm bringing you Campbell's, Hershey, Disney. We're looking at Under Armour. Yeah, like I'm all over the place. And this is what you're seeing. You're seeing that by potentially utilizing the Buffett method here of brand name companies at a discount and also swimming against the stream and implementing that strategy into less popular companies that are flying underneath the radar, you could seriously have the potential to outperform those brand names that are supposedly, quote unquote, so hot every single day when you wake up and read one of these headlines. I'm telling you. You mark my words. I'm telling you. You give this like about another month or so. We have the potential January effect coming in. I'm telling you, you give this a little bit of time. All of a sudden, it's going to be back up here at the double digits, and people are going to be talking about saying, "Oh yeah, Under Armour looks good. It's rebounding. Earnings are coming out. Buy calls, buy call." Now all of a sudden, it's in the crosshairs, right? But if you watch this channel, you'd know they're late to the party, man. Johnny come lately. Tell me something I don't know, right? We knew this. So when we're up here, tell me something I don't know, bro. You're late to the party. Here, let me show you my cost basis, right? Right? That's when you could break. That's when you could break. But no, I'm just kidding, obviously. Just having some fun with you guys. But let's go to stock charts real quick, and then I'll let you go, because we're definitely talking much longer than I wanted to. So let's look at the daily quickly. Okay, we're up here. Let me get this off. Okay, we're up here 940. Look at the RSI now up to 73 and 3/4. So now we're above that benchmark, and you can see the last time it hit that benchmark, it basically kind of immediately sold off. So this might be a stock that actually follows the RSI high and low benchmark. So of course, it's definitely not set in stone that it's now going to sell off. However, we've been pretty much beelining now with this insane market pump for the last several weeks. So now we're above the top Bollinger Band. The RSI is north of 70, so that's why maybe I feel like we might pull back here to like the 920s, and the stock just might, consolidate and potentially go into a downward channel. And just take a breather for a little bit. Look at that MACD absolutely raging since hitting that bottom. Just boom, blast off. And you can see it really chunked immediately back up. It was slowly pulling back, right? It was in the high 7s, mid 7s, and then boom, they brought it to 629. And then what happened? During October, while markets were selling off, mind you, boom, this thing chunked back up to 760 and change. And then of course, obviously it dropped back down, but you understand it immediately regained it again. So that's why when you see some moves happen like that, also, getting beaten up and hitting a low may not make sense, but then seeing how it rebounds and regains that value could potentially also be an indicator, in my opinion, that we're dealing with an undervalued stock that is just kind of insisting that it has to go higher. And basically since November, this stock has bounced multiple times off of the 50-day moving average, but has stayed above it. And going back to about the beginning of December, we can see we've gotten above the 200-day moving average and taken that next leg higher as well. And that's why I always look at these moving averages. Again, I know some people may say, oh, these are like old school, indicators and whatnot. Hey, listen, if we know we're down here and we have the potential to get back up here, and the moving averages are laid out like this, meaning that once we get up above here, we're going to bounce and then try to retest here. It's like, then we could potentially say, we know that, this is going from 6 to 850 or whatever the hell. You know what I'm saying? But of course, every situation is different. But yeah, MACD been climbing, stock been climbing, but I could potentially take a breather. Here on the weekly, the RSI is about 65, which technically means we didn't hit that 70 benchmark. However, going back in the past, we can see multiple times where the RSI almost hit 70, but then started to drop back down here on 2 separate occasions. Now, of course, past performance does not dictate future results. That is a rule and a fact. However, again, even if it potentially jumps up a little bit more tomorrow, 955 or something like that, chances are, in my opinion, that might actually be the end of it, and it may begin to pull back and calm down. As we see, the stock is also well above the top Bollinger Band on the weekly as well. However, on the weekly 50-day moving average, pretty healthy bounce there. tried to retest, break below it, regained, and then boom, popped even higher. So that's why we could maybe have another situation like this where it potentially calms down for a little bit, and then boom, we start climbing to the high nines, potentially double digits, back up to 10 plus, like we anticipated several months ago. Brought to you by Stocks by the Numbers. But I'm gonna end it there. So once again, Stocks by the Numbers. Thank you guys for stopping by. If you have any questions, comments, or concerns, drop that in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel, and subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand markets are rocky and volatile and uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you so much for stopping by, and have a good day.